All right, I'll go ahead and introduce our next speaker. It's Sanskar Neupane from Kansas Delta. He will tell us about exploring ways to model stock prices.
So hello everyone, I'm Sanskar Neupane from Washburn, and today I'm going to talk about exploring ways to model stock prices. Oh yeah, now it's working. So let me first start by saying stock prices are highly volatile, and there are not many methods out there that can model stock prices. The closest thing we have to a model that can accurately model stock prices is called a log normal model, which is also called a log random walk model, and that is used by most financial theories. Our goal of this experiment is to see if we can have any better method that will outperform the log normal model in case of stock prices. So for this, I'll be using S&P 500 for the initial phase of my experiment. S&P 500 is basically a market cap weighted fund containing top 500 largest companies in the US stock market. And I've used monthly data from 1993 to 2017 as a training data, and the data from 2018 to 2020 to test the model. To compare models against each other, I'll be using something called a test sum of square errors, which is basically the square difference between the predicted and the actual price in the test period, which is between 2018 and 2020. And the most promising methods found from this is used in the second half of my experiment in other stocks and cryptocurrencies. And for most of the modeling I do, I'll be using time series forecasting system, which is a plugin in SAS. So first, let me talk about log random walk model. Log random walk model, also known as log normal model or the Brownian motion, is based on the efficient market hypothesis. The efficient market hypothesis believes that the stock price returns are independent over time, and that makes the continuously compounded returns follow a normal distribution, and thus the stock prices will follow a log normal distribution. So I ran this model in Excel, and as you can see, the blue line is the actual stock price of S&P 500 monthly. And after the orange dotted line, this is our test period. And we have the two prediction intervals and the orange line, which is our predicted stock price. The blue line is kind of inside the confidence interval in this case. And from this, we get a test sum of square errors of 7,451. And from the other models, we'll be striving to get a test SSE, which is less than this, because less is better for SSE. So the first model we thought would outperform the log normal model is a Hall linear model. It's a really popular exponential smoothing model for forecasting data with trend. It's a weighted estimate with one constant term, which is kind of like a moving average that changes over time. And the growth curve is kind of like a slope that also changes over time. I ran the data through a log transformation before running the model because I believe that stock prices compound over time. So from this model, we got this graph from the time series forecasting system. This is kind of unclear, but the points after the blue vertical line, like this part, is going to be our test period, and this is the period we're most interested in. So I have a second graph, which is only the test period. As you can see, like the previous graph, the gray and the yellow lines are the 95% prediction intervals, and the orange line is the prediction, and the blue line is the actual stock price. As you can see, this model was kind of worse than the old model because it's always over predicting the model. And from this, we got a test sum of square errors of 22,625.77, which is higher than the old model. So we did not decide to pursue this particular model further. So the second model we tried was an exponential regression model. This is based on the exponential distribution. As you can see, the growth curve formula in the first bullet point, we can see that this blue line, which is the predicted stock price, kind of follows the trend. As you can see, kind of following the stock price, but it's not considering the up and down, like the volatility of the stock price. But if you look at the residual analysis, which is the difference between the blue line and the black line, you can see that the black line is kind of meandering across the blue line, which is a sign of autocorrelation. So first, let me explain what autocorrelation is. Autocorrelation is basically a measure of how similar a data set is to itself at different periods of time. We have two extreme examples of autocorrelation here. For positive autocorrelation, we can see that the lines, if they start to move up, they move up for a long time, and after a downturn, they continue moving down for a long time. That's an example of a perfect positive correlation. And a perfect negative correlation is the exact opposite. In the first iteration, the point moves up, and in the second iteration, it moves down. And then it alternates between moving up and moving down, which is a negative autocorrelation. And in concept of stock price, we can basically say that the autocorrelation refers to a degree of how the past stock prices changes will affect the stock price changes in the future. So after we added a lag one and a lag two exponential model, we saw that the blue line and the black line kind of overlap each other. That means this model was better than the last model. And it's also kind of counterintuitive to financial theories, because financial theories believe stock prices to be independent, and then being autocorrelated is the kind of exact opposite. So let's see how this did during the test period. Let's see that first. So as you can see, the blue line and the orange line are kind of closer to each other. We got a test SSC of 5,735, which is better than both the Hall's linear model as well as the log normal model. And let's also see the parameter estimates. We can see that the stock price has a positive lag one component seen in the auto-regression. Lag one has a positive 1.22. And let's see that the lag two autocorrelation is negative. That means the stock price of 1 month ago is positively correlated with the stock price of this month. So if the stock price is increasing last month, we can expect the stock price in this case to increase the following month as well. But if the stock price is increasing for 2 months in a row due to the negative lag two autocorrelation, we can expect the stock price to go down in the third month, which is also kind of interesting. So let's see the initial takeaway for the first phase of our experiment. We saw that the autocorrelation model did better than the random walk, which is counterintuitive to financial theories. We believe this to be the case because of the emotions present in investing. People like to buy low and sell high. That kind of makes it seem like there's emotions in investing, and which is the reason we believe there is autocorrelation in stock prices. That also means that the exchange market hypothesis, which believes stock prices not to be autocorrelated, and that the theory that's used in most cases to fail in the short term. Let's see the 3 SSEs. We can see that the exponential model with autocorrelation had the least SSE. That means that was the best model we found so far. That is the model we'll be using for the second phase of our experiment. So the questions we'll be starting to answer now is what kind of stocks are better suited to auto-regressive models, and whether they can be used to predict cryptocurrency prices as well. And if not, what are the other primary use cases for this? So we picked 4 different stocks from 4 different categories: Apple from the technology sector, ExxonMobil from the legacy oil business, Bank of America from finance, and Bitcoin as a representative of cryptocurrencies. We're going to see how autocorrelative models performs for those particular stocks, and if we can extrapolate that knowledge to those particular industries. The first one we chose was Apple. As you can see, it also has, similar to S&P 500, it also had a positive first order correlation and a negative second order autocorrelation. But we also saw a significant lag 3 autocorrelation and a seasonal trend here. Lag 3 autocorrelation basically means how price changes of 3 months ago will affect the price changes of this month. And the seasonal autocorrelation is basically how the price changes of last year's particular month will affect the price changes of this year's particular month. So let's see how it did during the test period. We did not calculate SSE for individual stocks because we can compare the SSE for, let's say, Apple with SSE of Exxon, because they have different prices to begin with. So we did not calculate SSE. And we can see the model and the blue line and the blue line and the orange line kind of follow each other during the first few months and then diverges away from the model as time passes. And this is the trend we'll be seeing in the future stocks as well. And the second stock we analyzed was the ExxonMobil. As you can see, the stock is kind of like almost stationary. So we did not use the exponential component. Instead, we did something called a forced differencing and then ran the AR2 model. So we can see that the lag component here is also kind of significant. The lag one is significant at a p-value of less than 0.05, but the lag 2 is not as significant, and thus the prediction made by ExxonMobil is not as good as the prediction that was made for Apple in this model. And we believe this to be the case because there's a significant dividend yield in ExxonMobil. That means people are not as excited to buy and sell. They are more likely to stay in the stock for the long term and then take the dividends. That is also a reason why there is not much speculative trading going on in ExxonMobil. And we believe that is why there is no autocorrelation, and thus the model kind of diverges. I mean, the stock price kind of diverges away from our model. The third stock we tried was Bank of America, and we saw that there was also a significant lag 1, lag 2, and lag 3 components like we saw with Apple, but there is not a linear trend in the graph. I mean, here, the linear trend has a p-value of almost 0.5. That means it's not significant statistically. But if you look at the graph, there's a clear linear trend before 2008, and there's a clear linear trend after 2008. The reason why the model thought that there is no slope is because, as you can see, this, if you connect these two lines, this is kind of straight. So the graph, the model believes that there is no linear trend, but the linear trend is evident evident graphically. That's also one of the drawbacks of the model we'll be talking about in further slides. But now for everyone's favorite, let's see how Bitcoin is modeled. As you can see for Bitcoin, there is a big prediction interval. You can see for this one, the price prediction range is between $350,000 and $40,000. So this is kind of prediction we can really use. And let's see how this does. So the Bitcoin also, similar to ExxonMobil, diverges around May of 2022. The possible causes for this is Federal Reserve had an interest rate hike around that time. That meant that cryptocurrency was not as popular of an investment than it was before the Fed interest rate hike. And also at that time, there was scrutiny on the cryptocurrencies, like many cryptocurrency funds were going bankrupt. That meant people were losing confidence over cryptocurrency. And that's why the graph kind of diverged away from our model. And now let's look at the effectiveness. So we saw in the last 4 examples that the autocorrelative model is more effective in stable market conditions and effective in stocks with high speculation and retail investing, like we saw with Apple or S&P 500 or Bitcoin before the stable market condition category was violated. And after this, let's look at the limitations, which there are many because we are modeling stock prices. The first one is it's not useful in low speculation, dividend paying stocks. Like we saw with ExxonMobil or Bank of America, the predictions were not as accurate because these don't have speculation and because they are dividend paying and there's not much retail investing seen over there. And also we determined that there was no efficacy in monetary sense because there was high prediction intervals. That means we can't use this model as much to make money. And also it seizes effectiveness once a major event occurs. For example, in Bitcoin, there was the interest rate hikes. That's why the Bitcoin diverged away from our model. And in case of Bank of America, there was a recession, which meant our model could not do as good. So once a major event happens, our model seems to have ceased its effectiveness. So let's look at the conclusion. We determined that efficient market hypothesis, which is the famous theory in finance, still holds in the long term, even though from S&P 500, it seemed that it did not hold in the short term. But still, the autocorrelative models can be used to predict short-term movements in high volume stocks in stable market conditions. So if the stock has a high volume and high retail investing and the market condition is stable, we believe that the AR models can still be used. And that also means that there are a lot of arbitrage opportunities in short term because of the EMS seemingly not holding. Let's look at some use cases for the future. So supercomputers and robot day traders can perform ORIMA calculations for shorter intervals. I did a monthly calculation, but the calculation could be done like every second or every minute using supercomputers. And if there was a pattern that could be exploited for monetary gain, those patterns could be exploited. And also it can be used in tandem with other technical analysis used in the market like MACD, RSI, Fibonacci retracements. These are some tools used by day traders now to make money. And I believe that the autocorrelative models can be used in tandem with these to provide more information to day traders. And primarily, I think for me, it can be used in academic settings for study of different stocks. Lastly, I'd like to thank my advisor, Dr. Gunan Hu, as well as professors from Washburn, Dr. Cook and Dr. Moser, as well as Mola University and KME for giving me this opportunity to come here and present my research to everyone. And thank you very much to you all for listening as well. And I'm free to answer questions. Yes.
So you talked about interest rates being an issue with Bank of America.
I guess it was with Bitcoin.
Was Bitcoin, yeah. If interest rates hikes were an issue, would that be something you would like to account for if you reduce project?
Yeah, that could be something we could account for, but the thing is, we don't know exactly when it will happen. So that means like we can't predict in the future. That's the problem. Like,
yeah,
that makes sense. Yeah, yeah. Yes.
So, going off of interest rates still, in terms of interest rates, obviously if interest rates are too high, people can't buy homes as much, or if interest rates are too low, then that's not necessarily a good thing.
Yeah.
I think that one of the big things that does make financial crisis happen is because, a lot of banks getting, adjustable rates, people who can afford their homes, and then, they defaulted. So, do you think that your model would be able to kind of see like a bubble happening when interest rates are too low and like stock prices are fluctuating?
Definitely, like if we improve it a little bit and then like account for like what's happening, if the stock price goes up like exponentially without any downturns, that means like there is a certain, like there's a chance of there being a bubble. And also like I think that was also because of the financial derivatives coming into place in 2008. Like people are buying mortgages, but they were also like using those mortgages to make mortgage-backed securities and selling those in the market. Also selling the second order derivatives, which was called adjustable rate mortgage or something, like in the Big Short movie, I think. And I guess not the interest rate was not the only factor for 2008 is what I'm meaning to say.
Stock recommendation.
Yeah, just invest in S&P 500 and then in the long term it will grow. Yeah, any other questions?
Second speaker again.